Let's take a look at a problem that relates to short-term decision making, and we'll look at make or buy decisions. In these kinds of decisions, management has to decide if they should make a part that goes into a finished product or buy it from an external supplier. And in these decisions, you don't really have any revenues that you'll be generating. All you want to do is look at what will be the lowest cost alternative. That will maximize income if you choose the lowest cost alternative. PPI must decide whether to make or buy a component for its elliptical machines. The cost of producing 40,000 resistance motors for the elliptical machines are as follows. Direct materials 100,000, direct labor 60,000, variable overhead 40,000, fixed overhead 80,000. Now with this information, a lot of times it is good just to combine the variable production costs because they behave the same way. If you incur materials cost, you're also going to incur labor and variable overhead. So I added these up just to simplify the problem, and they total $200,000. Instead of making the motors, the company has an opportunity to buy the motors at $6.20 per unit. If the motors are purchased, $50,000 of the fixed cost will be eliminated. So they can avoid $50,000 of fixed overhead, and of course they can avoid the direct materials, direct labor, and variable overhead if they buy the part from an external supplier. Prepare an analysis showing whether the company should make or buy the motors. So I'll set up a column for both make and buy. I'm going to use the total cost approach, meaning I'm just going to list every cost that will be incurred under either alternative. You could use the incremental cost approach. All right, if we buy the motors, we won't have to include that in the cost of making, but if we, in the column for buy, it's $6.20 times 40,000 resistance motors, or $248,000. Then, if we make the parts, we'll incur variable production costs, materials, labor, and variable overhead of $200,000. The fixed overhead, we're currently incurring $80,000 of fixed overhead. It says we can avoid $50,000 of that if we buy. So I included $30,000 there. You could have just included the $50,000 difference in the make column. You would get the same overall answer. Now, you may think, why can we not just eliminate all of our fixed overhead? And that's where you have to keep your short run perspective. We're going to have to maybe keep some of our floor space. Our rent won't go down, our insurance won't go down, those kind of things. So some of that fixed overhead is going to remain in the short run. So our total cost, if we make the parts, is $280,000, and if we buy the parts, it's $278,000. So in this case, we will save $2,000 if we buy the part. So then, of course, management will have to consider things like quality. Does the external supplier make a better product or maybe a lesser product than we can make? Timing, will the supplier ship on time? So there's other things they'll need to consider. Now we change things a bit and we say, assume that PPI could use the released facilities to make another product that would generate additional income of $45,000, but none of the fixed overhead costs could be avoided. Should PPI make or buy the motors? All right, so here we have an opportunity to make another product only if we free up the facilities by buying the part. All right, so this $45,000 is an opportunity cost if you decide that you're going to make the part. All right, so our analysis is going to look very similar to part A. We're going to have a purchase price of $248,000. That's the $620 per part times the 40,000 parts that are needed. But we're going to have incremental profit of $45,000 if we decide to buy. So I'm going to reduce that. That's like taking the money we get from producing and selling this new product and reducing the cost of buying. Variable production cost incurred will be $200,000 if we make the part, and fixed overhead will be $80,000 under either alternative. So obviously this is not relevant and could be just eliminated from our analysis. All right, so we get total cost of $280,000 if we make and $283,000 if we buy. So if we have an alternate use for these facilities, the company would save $3,000 if they make the part. And that's primarily because none of the fixed overhead can be avoided at that point. The profit from the new product line just simply did not offset the fixed overhead costs that are going to remain. One thing to note is that this incremental profit, you could have treated this as an opportunity cost of making the part, meaning you would add it to that column and have nothing in the buy column. But once again, your total cost difference will be the same. And that's how I will test it. So you can treat these however you best see it. The first time we experienced this during class, I treated it as opportunity cost. Here, I'm treating it as a reduction in the cost of buying, just to show you there's really no difference in the end based on how you treat that revenue generated from the new product line. All right, so that's a look at make or buy decisions. So what you want to do here is just choose the lowest cost alternative. Be careful about the fixed overhead. Sometimes you cannot eliminate all of your fixed overhead in the short run because you're locked into leases and insurance policies and salaries and that kind of thing. And also know what to do if there's an alternate use for the facilities. Either treat it as an opportunity cost of making or a reduction in the cost of buying.